Well, good evening. Thank you very much for sharing your important time with Greenleaf Trust tonight. We really do appreciate that. I want to take care of a little bit of housekeeping. On your table, we have the presentation in front of you. I say that because the screens are up there, but a lot of the data will be in smaller numbers, even though we try to get it as big as we can. And the chances of you seeing all of that, especially for those in the back of the room, are probably pretty slim. But we printed that out, and it's in front of you, and that is yours to keep. And you need to pay attention to it because there'll be a test afterwards. Okay. There is also a survey there, and I usually wait until the end to talk about that survey, and then I forget to do it. And then our marketing people are really upset with me. So that survey is there too. So we invite you to be a part of our quality control, our continuous improvement. That's a part of the fabric of Greenleaf Trust. And if you would invest just a portion of your time after the seminar or even during the seminar, to put your comments down there as to how we can make effective presentations for you. I'd really appreciate that as well. And so thank you again for coming. This is our 2019 year in review and our outlook for 2020. The way we're going to do this is I'm going to handle the economic part of this presentation, so I'm going to talk for about 20 minutes, which means it's probably going to be 25. And then I am really privileged to have our Senior Vice President and Director of Research, Nick Yulee, with me tonight. And Nick then is going to do the same kind of thing, talking about financial markets, and equities, and fixed income side. And then we're going to really turn it over to you, because we want to know what's on your mind. And we will stay as long as you want to answer whatever question you have. There are no bad questions. We've all been in situations before where we've been asked to, or invited to ask questions, and somehow we're mostly, we don't do it. And yet the person next to us has the same question in their mind too, and so it doesn't get answered. And so we will do our best to answer whatever question you have. We are thrilled to be here doing this. We celebrated our 21st anniversary last July, and so this year we'll be celebrating our 22nd anniversary. And that's the team at Greenleaf Trust now. We always thank you for being clients of Greenleaf Trust and advocates of Greenleaf Trust. 139 strong now. We started 21 years ago. We'll be 22 this July with literally 5 people. So we have grown tremendously, and we are very, very happy with that growth. And I am absolutely thrilled with this team. 139 strong. By the end of this year, we'll be 150. We now have offices not only in Kalamazoo, but in Grand Rapids, Petoskey, Traverse City, Birmingham, and now also in the state of Delaware. And when people look at the growth that we have had in now being one of the only privately held trust banks in the state of Michigan, whose assets now total $14 billion. We started with 0, and now we're $14 billion. That's kind of a nice growth plan, right? And people ask, Bill, why has Greenleaf Trust grown at rates in excess of double the industry growth rate? And to me, the answer is simple. It's a great business culture coupled with a great workplace culture. People say to me, Bill, you've got really good people. And I always break out in a smile with that, with the knowledge that yes, we do. And it's by intention, it's by design, it's not by chance. We started this company with the principle of saying we wanted to differentiate ourselves from the competition. We wanted to make sure that we were aligned at the hip with our clients, that there would not be any conflicts of interest. And those pillars of our core culture that we started with remain true today. We deliver that service in a team delivery model, and the reason for that is we believe that the collective wisdom is better than the individual thought. And so we surround our clients with the collective wisdom of trust officers, wealth management advisors, and team service coordinators, and we do that in a spirit of continuous improvement. So whatever we do today is not good enough for tomorrow. And we marry our budget to that continuous improvement process so that we can invest in everything that we need to invest in to do a better job for you, our clients. And we wrap all of that around the concept of honest and honorable. Trust is in our name. It's important for us to deliver on that. And that fiduciary excellence is what you expect, and it's what we strive hard to deliver. And it's that business culture that is married to a workplace culture that values that team, that encourages and enables and invests in that team, so that every team member is one more like our best. And we are absolutely thrilled, and I'm absolutely privileged to be chairman of that great company. So once again, thank you for joining us this evening. So let's get on to what's on your mind. And so it's really important for us to know what's on your mind, and how do we know what's on your mind? Well, sometimes you tell us, and sometimes we have other resources. In 2004, Google created Google Analytics. In 2004, they began to search for what are those people that are going on our internet-based site searching for? What are the top words that people are searching for? And you can see in 2009, 2008, people were searching the word recession. And the answer, or the reason, was obvious. We were in the midst of the second worst recession in our country's history. It was a recession that was caused by an implosion of capital markets, not a normal business cycle recession. People lost half of their retirement savings. Those people that were about to retire couldn't. Those people that were planning on retiring in 5 years had to continue to work. People lost savings. People lost their homes. Homes were foreclosed upon. The recession was caused by the syndication of mortgage-backed products and the amplification of home building that wasn't there based upon demand, but was there because of the syndication of mortgage-backed products. So it's different. It's a different recession. It was not a normal business cycle recession. And so it's obvious that people would be concerned about that and wanting to know about recession. But here's the thing that we noticed too. In 2019, it nearly matched the volume of search. So recession is on your mind, and there's good reasons for that recession to be on your mind. We are in the longest expansion period in the last 50 years. This is the longest expansion period in our country's history, in 50 years. The longest expansion period. So it's obvious that people will say, if it's the longest, then certainly it can't last. I know there's starting to be some frowns on faces here, I can see. Relax. The probability of us going into a recession in 2020 is pretty low. Now, we're going to talk about some of the risks to that as we progress during the seminar. But we have to also keep this in perspective, you know. There's a lot of other things that people search for on Google. So this is a comparison between, now the bottom is Are those people searching a recession? These are the people searching about Taylor Swift. So we do have to keep this in perspective. Some people ask the question, Bill, when are we going to be in recession? And I would tell you, I don't know. And I'm in good company because nobody else does either. We know the indicators that we look at, and we look at 50 economic indicators regularly. What you see here is the length of time that it takes the Bureau of Economic Research, who reports whether or not we are in recession. Recession is defined as 2 consecutive quarters of negative growth. So this is the length of time between when we started the recession, the last recession in 2008 period, and this is the length of time it took them before they could confirm that we were in that recession. And the average of that, of all recession reporting periods, is about 7.7 months. So 7 months after we began the recession, they reported to us that we were in the recession. That's comforting, isn't it? When we get economic data, it comes to us not like the closing price of a stock on a daily basis. So at the end of each quarter, we get a report on GDP growth. And it comes to us in the first estimate. And then a few weeks later, we get the second estimate revision. And then we get the third estimate revision. And then we finally get the final estimate. So it takes a period of time before we get that, before we know. Now, that pretty much tells you that it's pretty difficult to change portfolio construction or investments in anticipation of a recession, isn't it? That's why timing the market is very difficult to do. You have to be lucky on decisions and choices that you make, and then on the opposite side of that, investing in the expansion, you have to be equally as lucky in doing it. So on the other chart is how soon we know whether an expansion has begun. And you see the reporting of that is about 14 months, twice as long as the reporting on when the recession began. So on both sides of that equation, it's very difficult to be there first, isn't it? In fact, here, this period of time would have missed 27%, about 27% of the growth in equity markets during the beginning of that expansion. Now, we talk about gross domestic product. It's made up of, gross domestic product is really the total output of our economy, commonly referred to as GDP. And that's really what we're measuring when we're measuring recession or expansion. Is our gross domestic product growing, or is it contracting? And how do we know that? And what is the size of that? Well, the data that is the most recent data that's available to us, we don't have the full year data yet for 2019, but so we've compared September 30th of 2018 to September 30th of 2019. You can see that that represented about almost $21 trillion worth of our economy. $21 trillion was the output in 2018. That grew to a little over $21.5 trillion in 2019. That's about a little bit better than a 3% growth in GDP between those 2 years. And what's that made of? What drives that? What drives the growth, or what drives gross domestic product? And you see that nearly 70% of that is the consumer. That's you and I. That's what we do. It's what happens when we wake up in the morning and we go about our lives. In economic theory, it's referred to as the invisible hand of Adam Smith. There's 330 million people that get up every day and do something. 155 million of those people in our country get up and go to work. So it's the jobs they have, the wages that they receive, and the spending that they do, that we do, you and I do, the collective body of everybody that's working and everybody that's living in our country. That drives 70% of our gross domestic product. What are the other components then of it? About 17% is private investment. What do we mean by private investment? That's business investment in capital, machinery, software, all of the equipment necessary to produce finished goods, all of the equipment necessary to provide services. That's private investment for a portion of that, and the other portion of that is housing. So when we think of that lump, 17% of our economy is private investment, which includes business capital investment and also housing. The other 17% is government spending. And the remainder of that is the net difference between exports and imports. That's about 2%. 2% of the calculation of GDP. And if there's more exports than there are imports, then that's a positive GDP. And like in the reverse, if there's more imports than exports, then that's a negative. That's a plus or minus 2% in any one particular year on average. So if those are the components of GDP, then we better focus on how those components are doing, right? And we better look at the conditions that create either growth in those components or contraction in those components, and that's what we want to do. So I don't want to forget this side either, okay? So what we've done is to take out those drivers of consumer behavior. So we see real consumer spending growth, real consumer spending growth. Now, in the material in front of you and up on the screen, you can see that there's a lot of different lines there. What do those lines represent? Those lines represent different expansion periods in our country in the last 50 years. And what we want to do is to compare those expansion periods with our current expansion period. And where you'll be able to find our current expansion period is the darker dotted line in every graph that we will show you. The darker dotted line. So that's this one right here. And you can see that the amount of growth in consumer spending in the current expansion that we're in is lower than the growth in previous expansions. It is low, but it is consistent, isn't it? So you see the direction of the graph, low, lower than the others, but consistent. Now, the other thing that you will see consistent about every graph is there will be a little red line at the end of each one of those expansion periods, and that red portion of that, you'll notice, changes direction and goes down. That's when that particular expansion period declined. That's when we went into recession at the end of those expansion periods. And you will notice in our current expansion period, right here, there's no red line, is there? Because we haven't tailed off, we haven't declined in our real consumer growth spending. In fact, the report that just came out on December's was quite robust. It's one of the important economic indicators that we look at. We look at, in terms of predicting, and Nick will talk about this in a little bit more detail, but unemployment, consumer spending, and yield curve. And Nick will talk a little bit more detail, particularly about the yield curve. So, from a consumer spending standpoint, real, that means adjusted for inflation, we're in pretty good shape. Then we look at real private investment. Now, this is the area that gives us a little bit of pause. So this is business investment in capital, business investment in machinery, business investment in software. Normally, businesses invest in this kind of category as the economy expands and they are seeking more productivity. It's characteristic of the growth that we have had, very low interest rates. We have had huge labor supply up until recently, and businesses have been reluctant to invest in capital. Instead, they've invested in people, invested in labor. And because of some uncertain public policy with respect to tariffs, they've been reluctant to invest in capital as well. But it's a concern to us, and we want to watch it because you can see that in any one of these expansion periods, when those expansion periods were ending, it was when business investment was declining. And we'll talk about that in detail in a little bit. But you can see it's consistent, right? You can see the dark line, the dark dotted line is uneven, and there's been periods of decline, but it hasn't been consistent. It's kind of tailing over, though, now. So it's one of those flashing yellow lights. Pay attention to me. Pay attention. Flashing yellow light. We need to pay attention. Now, there are people that will explain it away. They will say that service is a much larger part of our economy now, and service isn't really considered, the service sector really isn't considered in this calculation. Part of that is true, but part of it isn't. We don't like to pay attention to that chorus of people saying it's different this time, because we've got a lot of history, right? Got a lot of history here. And if it was true then, we want to pay attention to it at least. More about that in a little bit. Now, the last one is government spending, right? That's the last component, government spending. And what typically happens after when a recession begins is that in two ways, government spends more money. They do that with public policy, usually with tax and incentives to spend, both for business and also for the consumer. And then secondly, in terms of monetary policy, the Federal Reserve makes it less expensive for banks to borrow money from the Federal Reserve. And the idea behind that is to add liquidity into the system and to allow for more lending to occur, to accelerate consumer activity, and therefore expand the economy. And so what we have had is, in fact, the case where government spending has increased here. Somebody told me it's election year. Unless you're living under a rock, you know that. What are the chances in 2020 that candidates will be standing up before you and I, the collective political body, and saying, I want to raise taxes, and government's going to spend less? What's the probability of that happening? So when we look at that portion that drives about 17, a little bit better than 17% of our GDP, it's not likely that government spending is going to be decreasing. We'll talk about that in a little bit. So now we want to talk about in a little bit more detail the consumer, because the consumer represents about 70% of the growth in GDP. So how's the consumer doing? If you read our newsletter, you hear a couple of things that are true for quite a while. The consumer is employed, and for the last 2 years, the consumer has been receiving wage increases. The wage increases have accelerated, particularly in the last 18 months, and the consumer is confident. So we measure consumer confidence through two surveys. One is the University of Michigan survey, and the other is the Conference Board survey, but essentially through all the questions, whether it's through the phone home survey or the written survey, really trying to get at the same thing. How does the consumer feel about the condition that they're in And how do they feel about the condition that their neighbors and relatives are in? Trying to measure confidence, because a confident consumer spends more. So in terms of job growth, the unemployment rate, lowest in 50 years, 3.5%. When we were first trying to fight the impacts of a recession, remember unemployment in the state of Michigan? Unemployment, 11% in the state of Michigan. The national average at that point was 8%. The state of Michigan was 11%. U6 unemployment, that's the category of workers that are last hired, first fired. That's the category of workers that find themselves without full-time employment or are underemployed, was at 20% in the state of Michigan. Currently, unemployment is at 3.5%, as I said, a 50-year low. And when we look at U6 unemployment, it is also at a 50-year low, now at 8%. Tremendous improvement in employment. In fact, when the Federal Reserve Chairman Powell, recently talked about Fed policy, he used some language which was unusual that I haven't heard in my career in this field. He talked about the moral imperative of continuing the expansion. And the moral imperative that he was talking about was that in the last 18 months, those at the bottom of employment were experiencing sustained growth in their employment. People were moving from part-time jobs to full-time jobs, from full-time jobs to better full-time jobs, and receiving wage increases. And while the top of the economic strata had benefited tremendously from the capital appreciation of the growth from the bottom of the recession to where we were right now, for the last 18 months, those at the bottom were benefiting. And he talked about the moral imperative to make sure that Fed policy and fiscal policy sustained that growth. So the consumer's employed. The consumer has had wage increases, and the consumer is confident. So when we look at that portion of the economy, 70% that the consumer is responsible for, we're feeling pretty good about that right now. Feeling pretty good about that. So now let's move on to business. This is the one that I said we've got a flashing light. So the Institute of Supply Management also conducts surveys. And the people that they are surveying are those people that are in the position of purchasing raw materials, commodities, components of production that are necessary in the whole logistical supply chain to produce finished goods for consumers to buy. So that's who they're surveying. It's often referred to as the PMI, or Purchasing Managers Index. And this is a global survey, and it's a survey of large manufacturers across all sectors of the economy. And really getting at the question of, in the forward period of time, what are your purchasing practices? What are you going to be doing in the forward period of time? Generally, when these results of this survey are at 50% or above, we are in an expansion period. When it is below 50%, we are in a contraction period. So let's look here. That's the current data. Again, the dark dotted line is our current expansion period, and you see that it has been below 50%, and now rose above it, and now coming down to that 50%. What are the other charts? The other charts are every other expansion period in the last 50 years. So look for the red. When it declined below 50%, that was also indicative of a continued decline and recession. Consistent, isn't it? So we're concerned about this. We're watching it. This is the yellow flashing light. So when we look at that portion of business investment, now I said that portion is 17% of GDP. It's not quite true. That portion is 6%. The other 11% is housing. So now we'll want to take a look at that. And this is the data on housing. So I mentioned before briefly, and we have written extensively on this. We have had seminars about it. Those of you that have been with us for a long time know that beginning in 2008, constantly talked about the conditions that created the recession back in 2007, 2008. And a major portion of that was that syndication greed and investor greed came together and created mortgage-backed products that were faulty and built on a foundation of sand. It eventually imploded and crippled our financial markets and our credit system and our banking system. 2006 and 2007, we were producing 1.4 million housing units per year. I'm talking about single-family homes, 1.4 million. That data point is irrelevant if you don't know how many did we need. And the answer to that is we needed 600,000 per year. But we created 1.4 million. So again, it was a housing market built on a foundation of sand. So where are we today? Today we are producing about what we should, 600,000. When I say what we should, that is to meet the needs of our population. We are a mature economy in a slow growth population. We trade mostly with trading partners who are also mature economies whose populations are either growing or slightly negative. If it was not for immigration, our population growth would be negative too. So our population grows at about 1% to 1.5% per year. So the amount of housing that we need, new stock housing, annually is about 600,000 units. So what's the health of the housing market right now? We are producing about what we should produce to meet the needs of our population. Now, these two graphs here are interesting, and you can look at those in some detail, but the credit quality of mortgage applicants at the period just before that implosion in the housing market was quite low. In other words, there was a segment that was a segment of our population that weren't really buyers, owners, but were being marketed to, and the credit quality of that segment was low. So we want to know, because people are concerned about consumer debt. People are concerned about corporate debt. Not too many people right now are concerned about government debt. That's kind of interesting, isn't it? You know, there's a study done by two professors, one from Yale and one from Stanford, and they purposely got together because Yale is considered kind of a liberal economic academia, Stanford more conservative. And what they did was they studied 80 communities. And what they wanted to know was, what was the determining factor in how people interpreted data? And what they found through a series of longitudinal studies on questions and surveys of those 80 communities was it really depended upon if your person was in power, if your person held the White House. Same economic data, same set of circumstances. But if your person was the president, that data was good. If your person wasn't the president, that data was bad. So how we interpret data goes through the lens of our political body, our individual political body. So when we have people saying that, yeah, the economy is good, but there's too much debt, when we have people saying, deficits don't matter now. Same people that said deficits mattered in 2015, right? But now they don't matter. It's because we look through that political lens. We don't look at the data rationally or objectively. The collective we looks at it through that political lens. But the reality is the credit quality of borrowers right now is much better than it was in 2006, 7, and 8. Are there areas to be concerned about debt? Yes, and one of those is student debt, and we have to resolve that somehow. But as far as consumer debt and business debt, it's lower than it was prior to the recession of 2008. So from a housing market standpoint, that portion, that's 11% of that 17%. Things are pretty good. Now, the last part is government, right? That's the other 17% that drives GDP growth. So what we've done, now, if you and I have a budget, there's some CPAs in this room, and if we have a budget, our personal budget, those of you that own businesses, your business budget, those of you that might be on city commission, municipal budgets, state budgets, we all have a budget that usually we start with knowing what's our revenue going to be. We can't get to the solution of what can we spend unless we know what it is that we're going to have on the revenue side, right? And we can't just say, well, we'll just get more money. We'll just get more revenue. We have to have some basis for that revenue. How does that revenue come to us? If we're employed and we have a wage, we can't wish it would be better. We have to somehow make it better. If we have a business, we can't wish it to be better. We have to go through the execution and the strategies to make it better. Now, that applies to everybody except federal government. That's the only entity that doesn't construct a budget that way. So when we look at both spending and revenue, these are the major components of that in every fiscal year. And these percentages don't change that much from year to year either. So we have major health programs, we have Social Security, we have defense, we have, what's this? Interest payments. Now those have a direct relationship to this deficit. Now, fortunately, for the past 12 years, we've had very low interest rates. If interest rates were higher, this portion of interest payments on the deficit, on our debt, would have to be much more. And if that was more, then spending in each one of these areas would have to be less, unless we just add it to this. So, remember, we're in an election year. This is what we're spending. This is our revenue. The revenue components are about the same too, in terms of percentages. They don't change that much. And there might be some surprises to you right here. So what we start with are individual income tax. And that's currently producing about $1.7 trillion a year. And went through some tax reduction, didn't we? Didn't we go through tax reduction? Somebody told me that. There's something in the newspaper about that. This number was actually $1.6 trillion last year. It's 1.7. All right, payroll taxes. That's a portion that people are employed and employers pay for payroll taxes. And that number is about $1.3 trillion. So together, it's about $3 trillion of the total federal budget. The Office of Management and Budget just came out with a run rate estimate for 2019, just a little bit ago. It was just in 2 weeks ago. Anybody recall what that number was for the full fiscal year? Was it 3 trillion? Started with a 4. 4.1, I think it was, $4.2 trillion is the estimate of what our total expenditures will be. So these two largest components are about $3 trillion, and this one, this might shock you too, because we've heard that corporate taxes are too high, right, Mark? Corporate, too high, right? Well, they're 5%. 5% of our total revenue generation is corporate taxes. It's not political, I'm just stating the fact. 5%. This other portion is fees. So we have a lot of fees. You go to the national park, pay for your sticker, that's a fee. You apply for some kind of permit with the EPA, that's a different kind of fee. But nonetheless, that's that fee portion. Now we add all of that up, those numbers come to about $3.5, $3.6 trillion. Or I think it's actually less than that, but we're going to spend another $1 trillion on top of that. We're going to add that to the deficit. So when we look at the components of GDP growth, I don't think we're going to spend less in 2020. It's an election year. When was the last election that you witnessed, participated in, where you had a candidate win that said we should spend less and tax more? That doesn't happen in elections. When people say that, we put them out in limbo land. Political limbo land. So that's probably not going to happen in 2020. So now when we go back through all of the components and we get here to what makes up GDP, the consumer is strong right now. The consumer has carried us for a long time. Carried us, we, right? We're the consumer, right? We have carried we. Business investment has not been where we would like it to be. Productivity has not grown. The amount of output per unit of labor has not grown. But the consumer is employed, the consumer is receiving wage increases, and the consumer is confident. Housing market is stable, and the government is spending. Those conditions are likely to continue. The probability of those continuing in 2020 is quite good, which gets us to our traditional economic barometer. And this is kind of when we do all of the calculation on all of those components, we do the math on it, and we try to do two things. We try to look at the drags on the economy, those things that are questionable, concerning. We have, at the top, business surveys appear to be weak. That's the Purchasing Managers Index. That has us concerned. Business investment has slowed, so that's kind of, that dotted graph is kind of turned over. Earnings growth, and Nick will talk about this in some detail, has slowed. We have geopolitical uncertainty. Well, that's not anything new, is it? For the last 21 years, as we've been doing these seminars, we've had geopolitical uncertainty. It's out there. It's a part of our lives. It's not something that we can plan for other than it's just there. It's one of those things that can interrupt economies. It can particularly interrupt slow growth economies. So 2% growth is not robust. It's been steady for now going on 12 years. And the aggregate result of steady growth for 12 years has been very meaningful, hasn't it? It's reduced unemployment, more people have jobs, more people have received growth in those jobs, more people have recovered their retirement savings, more people have added to their savings, consumer debt has not increased, consumer savings has remained stable. Those are all positives of that. We have an election, and we cannot tell you either what the result of that election is going to be, nor can we tell you what the public policy changes will be at this moment in time. After the election, we can all know that, but we can't know that before. But what we do know is elections matter, and elections do impact public policy, but Nick will talk to you about, because people are concerned about how the election will affect their investments. Nick will talk to you in detail about that. And then we are, of course, entering the 12th year of the recovery. All of these are the worry things, right? These are the potential detractors to economic growth. And then on this side, we have the positives. So we have a solid consumer. We've seen that in the data. Continues to be pretty good. Credit availability is strong and the quality is there. We have accelerating wage growth. We have accommodative global central banks. So every equivalent to our Federal Reserve throughout the globe is in an accommodative state. Accommodative means they are increasing money supply, they are increasing credit availability, they are decreasing interest rates. That's good for us on the export side. It's good for global growth, and therefore it's good for those consumers that we want to sell into. That's a positive. Energy prices and inflation remaining low. That's a positive, and we have a stabilized housing market and from week to week, moderating trade risks. And so what does that all mean? We take all of the calculations of all of those components of GDP growth, we look through that lens, and what we say is about more of the same. Between high 1% range and mid 2% range, that's where we think the barometer will be for 2020, which will be essentially more of what we experienced this year, last year, and that economics, that growth slope that we've experienced for the last 11 years. So probability of recession is not high. We wouldn't call it even moderate, but there are some concerns along the way. I'm going to end my portion of the presentation right now. I'm going to turn it over to a very smart person, Nick Yulee. He's going to tell us about the equity markets, fixed income markets, and some of those things with respect to elections and things like that. Then, there is no bad question. Remember that. Write it down if you've got it. Comments that you have, disagreements with our assumptions, and we'll get at that when Nick concludes his portion. Nick, take it away.
Good evening, everybody. Thank you all for being here tonight. I'm Nick Yulee. I'm the Director of Investment Research at Greenleaf Trust. Before I dive into my portion, I just want to take a moment and highlight both the scale and depth of our in-house research team at Greenleaf. It currently counts 11 individuals. The organization's been growing, but our division's been growing too. I'm lucky enough to get to be up here and speak tonight, but I want you to understand there's a whole independent team behind me contributing to this presentation. So we've spent a lot, we've invested a lot in this team and the growth and development of this group and this division over the last few years on behalf of our clients. With that, let's just jump right in. we have been talking a lot about the economic cycle. Bill talked a lot about the business cycle. And maybe at this point in the presentation, you're saying, yeah, but why do I care? Well, who cares? Why do I care? Well, what we've got here is the S&P 500. And what we're showing you is the S&P 500 from 1927 through the end of last year. We have overlaid it in blue with drawdowns of 15% or more, and in red with drawdowns of 20% or more. And the pink verticals represent recessions. And the reason why you care about the business cycle is because the recessionary portion of that business cycle frequently coincides with a drawdown in the market. Over the last 75 years, post-World War II, we've had 17 drawdowns in the market of 15% or more, so 17 examples where we've got a colorful overlay there. And 9 of those drawdowns, 9 of the 17, coincided with a recession, including some of the more severe drawdowns that you see up here more recently. Now, there's a couple takeaways I want you to have from this slide. First of all, if you think about what I just told you, significant drawdowns happen almost twice as often as a recession. But we're worried about the recession. We're worried about that business cycle. Secondly, when these drawdowns occur, in the grand scheme of things, they tend to be pretty short-lived, and they're typically followed by a recovery. And I'm not saying they're fun. This is not fun. That's not fun. But in the grand scheme of things, there's a very clear long-term trend to this line, and it's up and to the right. A couple other things to make note of. We have seen examples of a recession where there wasn't a significant drawdown. They didn't coincide. And we've also seen examples clearly, therefore, of significant drawdowns that didn't coincide with a recession, the most recent of which was in the fourth quarter of last year, fourth quarter of 18. U.S. stocks declined just shy of 20%. And it was this business cycle framework and long-term orientation that we use that helped us avoid getting too defensive in a year like 2018 and allowed our clients to reap the financial rewards of a year like 2019. And just how did the year shape up? Well, I think Bill made it pretty clear. 2019 marked the continuation of a lengthy economic expansion, another year of growth. And across almost all major asset classes, returns greatly exceeded our expectations. So the chart here, the dark bars show you the 2019 total return of the asset class. The lighter bar on top shows you the 5-year trailing annualized average return of that same asset class. And we put that in there just for some perspective. Starting in the far left in red, all core equity groups up strong in the double digits, led by domestic large caps. It's effectively the S&P 500, returned almost 32% last year. Bonds impressed as well, mid to upper single digits across core bond indices, double digits in high yield, and a variety of alternative investment assets and strategies held their own as well last year. And in fact, in 2019, even a balanced portfolio, 60% global stocks and 40% bonds, returned just shy of 20%. That's almost 3x the historical average of what you'd expect from that portfolio. So what we're telling you is, yes, 2019 was an exceptionally strong year for the markets, and you probably already figured that out. But what a difference a year makes. So let's think back. On this chart, we're showing you in blue, that's the experience this year. That's the experience of the S&P 500, domestic stocks. In red and green, we've got international equities climbing higher as well. And in the bottom, in gray, we highlight global equity returns, the experience for global equities in 2018, including that fourth quarter drawdown that we talked about, the extreme drawdown that occurred. And this time last year when we were doing this presentation, we talked about the fact that the markets seemed to be behaving as though they were anticipating an immediate recession as we entered 2019. But based on the indicators that we follow and the data we were seeing, we didn't see how that was possibly going to be the case at the time. Certainly, some of the strength that we saw in equities this year represents recovery from that drawdown in the fourth quarter of last year. So it's where you start matters. But across all these categories, pretty much all major equity categories ended the year at or near record highs still. So we peel this back a little bit. Let's look a little more deeply at domestic stocks. And this is broken down by sector. So all the different industry sectors are represented by various lines. And in the context of that 32% return we talked about for the 500, you'll see that there's actually a pretty high degree of dispersion here across sectors. In the middle, there's kind of this bolus between 20 and 30%, so most sectors were kind of in that ballpark. But notable outliers included information technology, up just about 50% for the year, and energy, which was up only 10% for the year despite rising oil prices. Oil was up almost 35% last year. Some of this dispersion in growth is explained by dispersion in earnings. So different sectors had different levels of earnings growth, and that explains some of the return differentials. But when you put all the earnings together and say, what did the S&P 500 do in terms of earnings? Flat. No growth. Same level of earnings in 2019 as you experienced in 2018. Up here, we've got another one of our business cycle charts. We're showing cumulative earnings growth throughout this most recent expansion. And what you would expect with a business cycle is peak earnings followed by a decline. And what we see here is the line. We did not add to cumulative earnings this year. Earnings did not grow, so the same level. We're still right here. And that's also represented at the bottom. That little gap between the blue and the green, we had a bar there, that would represent growth. There was no growth in earnings last year. Fortunately, the green represents the consensus expectations for earnings growth in 2020. And that's telling us that at the moment, the expectation is not for an earnings decline, not for our black line to trend downward, but for earnings growth this year, on the order of about 10%. And if that's the case, and that's true, and that's what we experience, then our business cycle line here continues higher. As for bonds, following a lackluster 2018, growth rebounded in 2019 as yields declined, as credit spreads narrowed. Fed had a little bit to do with this success. Entering the year, they were anticipating 2 rate increases. By the end of the year, when all was said and done, they had cut rates 3 times. Heading into 2020, the Fed's saying we're going to keep rates constant. We're going to keep them right where they are. The market's pricing for 1 additional cut. We'll see what happens. All right. So far, this has been a history lesson. I'm talking to you about 2019 and what already occurred. And you probably knew most of it. And you didn't come out here to hear about that. You came out here tonight because you want to know what's going to happen, or at least what we think is going to happen. You want the forecast. So what have we established? We've established that we are in the longest economic expansion in U.S. history, represented at the top here. We know that there will be another recession. That's the way the business cycle works. There will be another recession at some point in time. And when people like me in this business, and even the people on TV, talk to you about there's going to be a recession, there's not going to be a recession, they're really talking about a window of time about the next 12 months. Because everybody knows there will be another one eventually, but we're basically handicapping for the likelihood of it happening this year, 2020. Bill told you that the likelihood is not too high. And how do we know that? He's walked you through some of the economic indicators. We look at recessionary indicators, and they give us a pretty good sense. They help us to evaluate and handicap for the likelihood of a near-term onset of a recession. Today, I'll walk you through a couple of them, but today, suffice to say that the picture still looks pretty compelling, that we're going to get through 2020 without a recession. The first one, this is by far the most boring one, by the way, so we'll get this one out of the way, and then we'll move forward. The yield curve, research shows that relationships between short-term yields and long-term yields can be a good indicator of future economic growth. And particularly a yield curve inversion, which is when short-term yields exceed longer-term yields, can be an indication that a recession is approaching. This indicator has predicted the last 7 recessions, 7 of the last 9 recessions, actually. There's also been 2 false positives, so 2 examples where the yield curve inverted, but it wasn't followed by a recession. And historically speaking, it's taken yield curve inverts, you've got 4 to 24 months, and somewhere in that window is when you're going to have the recession take place. Well, the yield curve inverted in March of 2019. And so if I just took simple math and said, I'll add 4 to 24 months to that, I'm talking about either July of 2019 or March of 2021, somewhere in there, there's a recession. And if I'm telling you that I don't think there's going to be one in 2020, but my window only exceeds to the first quarter of 2021, that seems pretty tight. But there's some good news here, because luckily in the back half of the year, after the yield curve inverted, the Fed took action. The Fed cut rates 3 times. And at this point, the yield curve is no longer inverted, and that accommodative policy reduces the risk of a near-term onset of a recession. There's precedent for this. We saw a similar dynamic in 1998. The yield curve inverted, and unemployment was continuing to fall, the economy was continuing to grow, and the Fed took action. They accommodated, they cut rates, the yield curve uninverted, and it was actually 3 more years before we entered a recession. And that was 12 months following the second, another yield curve inversion. So right now, we think this one looks pretty good. Unemployment rate. Bill had a slide up here where he talked about job growth, slow and steady, adding jobs for the last decade. And this is kind of the flip side of that coin, right? So adding jobs means unemployment is coming down. That's a good guy. And so what you're looking for here is a trough. If unemployment starts to rise, then that can be an indication that a recession is near. And this one you can understand. It's pretty easy to understand, in fact, because why would unemployment rise? It would rise because businesses weren't growing, they're laying people off, they don't need to employ as many people, et cetera. So typically, historically, you've had a trough, and you can see all the troughs here. They're very easy to identify historically. And about 9 months after that, you'd have a recession. The difficulty is knowing when we're at the trough before it's in the rearview mirror. There are some ways you can evaluate that, but we could have easily said last year when unemployment was at 3.9% that we were at a trough. What we know is we've been continuing to add jobs throughout all of last year, and entering this year, the labor market seems to be on solid footing, so we feel pretty good about this too. Last but not least, real retail sales. This ties back to the consumer. We want to see real retail sales growth. Why would we see real retail sales growth? Why would I spend more on Amazon and at the mall and everywhere else this year than I spent last year? The reasons are economic. The reasons are because I got a job, I got a raise, I got a promotion, I got a bigger bonus, I got more hours in. All of those things cause me to spend more money. I'm confident. My investment portfolio has appreciated. The flip side of that coin, why would I spend less? I lost my job. I didn't get a bonus. I didn't get as many hours. My asset pool has decreased. So you're looking for continued positive real retail sales growth. And this one actually indicated in December of last year. If you remember, if you were sitting here, you had that market drawdown, confidence was low, people were less excited, and it touched negative, minus 0.3%. So barely negative, but it did indicate. However, throughout the course of this year, it's been consistently positive to the tune of 1.6%. And we just got a new reading on it this morning, which was that average through November was 1.6%. Today it was 3.5%. Really strong holiday season this year. So again, we feel good about the consumer. So you put these 3 things together, and we don't have this bright flashing light. We don't have this bright signal that's telling us that we're going to go into a recession. And we've basically decided, we believe that in 2020 we won't have a recession. And Bill told you we think the economy, in fact, is going to grow about 2% this year. But there are some risks to that view. There are some themes, there are some activities that are going to occur this year that can affect that. And I'm going to walk you through some of them and how we're thinking about them. First of all, within domestic politics, a couple of things going on here. Late last year, President Donald Trump was impeached by the Congress. We and everyone else, it's not just us, are fairly certain that he will be acquitted by the Senate in the next few weeks. We don't think that this process is going to have much of an effect on the markets or the economy, but it makes Donald Trump the first president to run for re-election after having been impeached. So it's interesting. It's never happened before. There's no playbook. There's no history. We can't say, well, that tells us that the election will go this way. We are in an election year. Bill mentioned that a couple of times. And we think that the presidential election it's a toss-up right now. Could be a Democrat in office, could be a Republican in office. Senate likely retains, the Republicans likely maintain the majority of the Senate, Democrats in the House. So those are what we're expecting. We've gotten a lot of questions. I've gotten a lot of questions. One is, hey, Nick, it's an investment year. It's an election year. It's an election year. What does that mean? How does that affect the markets? How do you think about that? And the other one is, hey, Nick, what if Warren gets elected?
Perfect.
What if Bernie gets elected? What if Donald Trump gets reelected? What if, insert the candidate's name here, gets elected? And the implication of that question, and it's frequently verbalized, the next sentence that comes out of their mouth is, we know what that'll do to the markets, right? So we looked into this. We looked into these two things, election years and who's in power. We looked back 84 years, that's 21 presidential terms, 11 of them were Democratic, 10 of them were Republican. And first we looked at the returns over those 84 years. Each calendar year, what was the return? And on average, the returns of the stock market across 84 years were on the order of 6 or 7%. So then we plucked out the 21 election years that came in there every fourth year, and we said, okay, let's find out, what were the returns like in election years? They were on the order of 6 or 7%. So what that tells you is that on average, election years are kind of average. Then we looked at, well, maybe it matters who's in the White House. Is it a Democrat or is it a Republican? And we had about a 50-50 split. And we looked at all the Republican years and all the Democrat years. And we said, how the returns compare? They were indistinguishable. They were exactly the same. And so our conclusion there is that when you go to the voting booth in November, you should vote with your ballot and not your portfolio. That's how we think about that one. Moving on to geopolitics, the US-China trade war rambles on. We made some progress this week. We signed phase 1 yesterday, so that's good. But the substance and the timing of phases 2 and 3 is yet to be determined. Those are uncertainties. We don't know what will happen, and we've seen these negotiations and discussions break down before. And frankly, the substance of phases 2 and 3 is probably the more important stuff around IP and other areas that are just structural concerns. Brexit, this one's pretty much over and done with. 3.5 years after the referendum, Boris Johnson appears to have the votes to get his Brexit deal done. Hopefully, without any surprises, we'll have an orderly Brexit by the end of the month, and we can take this one off the slide for next year. Now, Meghan and Harry are leaving the royal family. That's Megxit, and that's an uncertainty too. Number 3 here, unless you've been living a life completely void of all media for the last 2 weeks, you're aware of the fact that there's been an escalation in hostilities over in the Middle East between the US and Iran. I'll just reiterate what Bill said. Geopolitical tensions are a constant. They're always going to be there. And they will ebb and they will flow. There will be flare-ups over time. You need to try your best not to react to the headlines when some of this stuff happens. You look what happened in early January. We put out a piece, but if you had reacted to those headlines here 2 weeks into the year, you would have been worse off. Monetary and fiscal policy, we talked about the Fed. Right now, the Fed's saying we're not going to have to cut rates. We will only cut them if things change enough and deteriorate enough that we need to. The market's thinking they'll need to cut them one time, which means the market is a little more pessimistic than the Fed. So we'll see how that plays out. Other developed market central banks, many of which already have very accommodative monetary policy, incorporating even negative interest rates in some cases. The consensus there is that none of them will change their policies next year, but they may have to. So we'll see how that plays out. That's an uncertainty. Last but not least, fiscal stimulus, so government spending in the event of a slowdown to help boost an economy around the world, whether it's Germany or China. Will they step in and make those expenditures in the event of a slowdown? So what you see here is we have a lot of issues, a lot of things that are going to occur this year that are going to shape how the year plays out, and they're unknowables. We don't know how each and every one of these things will play out, and B, we don't know how, even if we knew, we don't necessarily know how the market will respond to those things, which makes it very difficult for us to then say, well, in 2020, we expect the market to do this and to pinpoint that target forecast. What will the stock market return in 2020 is a very difficult question to answer. You need only go back 12 months ago And I don't think you found very many people that told you the S&P 500 will be up 32% this year. So what we do is we have a much better sense for how markets will behave and what returns will look like over a longer period of time. And as we develop our capital market assumptions, which is our expectations for future asset class returns, we do that within a 10-year framework. I'm going to hit a couple of the highlights and then I'll show you the whole kind of rundown. With stocks around the world, valuation is key. So starting valuation matters a lot. And if stocks start out with valuations that are below average and they start out cheap, your forward return expectation is going to be higher. And vice versa. So if stocks start out a little too expensive and valuations are above average, your forward expectations are going to be lower. Now, given the type of returns that we've experienced over the last decade, cyclically adjusted valuation multiples are above average right now. And that tells us that looking forward, we might anticipate not a crash, but lower expected returns. This is one component of the analysis, but as we look through earnings growth, margin expansion, revenue growth, et cetera, we believe that looking forward over the next decade, you'll have something in the mid-single digits type of return from your stocks, your domestic stocks. And that 10-year annualized average means that you'll have years where it's better, you'll have years where it's worse, you may have years where it's modestly lower, but on average, a disciplined investor with their money in the stock market should expect a mid-single digit return from US stocks. With bonds, it's all about interest rates, starting yields. So higher interest rates, higher starting yields suggest better forward-looking returns from your bonds, and vice versa. A lower starting yield, lower interest rates suggest lower forward returns from your bonds. Entering 2020, the yield on a core bond index was 2.3%, which supports the notion that looking forward, your bond returns will be lower than they have been historically. We do similar analysis for all the different asset classes or the major asset classes that we pull into client portfolios, and we share those results with you here. What I'll tell you is that in most, but not all cases, our current forward 10-year looking return expectations are below long-term historical averages. So lower going forward over the next decade is how you should be thinking about your total portfolio and your investment solutions. This is my last slide, and then I'm going to invite Bill back up here to join me for Q&A. Let's pull it all together. What have we told you? We've told you we expect current expansion in additional expansion in 2020, not a recession, but there are risks to that view. There always are. In the short term, the market experience can be pretty unpredictable, so it's difficult to understand how the market will behave over a 12-month period of time. And we know that the expansion isn't going to last forever. Eventually, there will be another recession. Fortunately, we build portfolios for the long term. When we think about portfolios, we don't build a 2020 portfolio. We didn't build a 2019 portfolio. We build portfolios based on those 10-year capital market assumptions looking forward over the long term. And when we do that, we know a few things. We know that in the next decade or two, we'll probably have a recession or two. We know that there will be ebbs and flows and geopolitical tensions. There will be flare-ups and calm downs. We also know that there will be presidential elections, and the party in power will likely change a couple times over that window of time. So we know all of these things are going to happen. We anticipate them. When you sit down with one of our advisors and they get to know you and they ask you a bunch of questions and they understand what your goals are and what your needs are and what you're trying to plan for, and they determine on top of that financial plan, what is your portfolio going to look like, they put it in place with all these things in mind. We're not going to try to time when each one of these things occurs. We know that they're going to happen. And so the only way you can kind of goof that up is by losing discipline, is by abandoning that plan over the short term. You see a headline, you see something happen in the news, there's an election year, something's going to happen, and you abandon that plan. That plan took all these things into account already. 2020 might be a really difficult year to stay disciplined. There's going to be a lot of headlines. We talked about all the things that are going to be going on. It might be a really difficult year. You might want to pick up the phone and respond emotionally and say, I need to go to cash. And that's the worst possible thing you can do. It's the worst possible thing you can do. Because maintaining discipline during periods of uncertainty is the most reliable course for growing and preserving your wealth over the long term.
We want to thank you very much for sharing your precious time with us tonight. We hope that we have gotten to what you wanted, needed, and desired as far as information about 2020. And we stand ready to stay here afterwards and answer whatever questions you might have. Thank you very much for coming. Thank you for your business, and thank you for your advocacy for Greenleaf Trust. Thanks very much.